Welcome back, and I assume we're all ready to go with our beer, coffee, water, whatever you got. So, to introduce myself, my name is Kevin Code. I'm a partner here at Talbot Associates. I work on all sorts of different things, but mostly corporate and personal tax. As many of you may know me from doing your personal taxes or corporate work. This is our live TNA Live number 10 that we're doing. Our topic conversation today is going to be advantages and disadvantages of incorporating. It's a really interesting topic. This is something I love to talk about because it's a mystery to a lot of people. I think my favorite way that this comes up a lot of times, as a lot of tax questions do, people come and say, "Hey, my friend said incorporating is going to save me a lot of money. My friend told me this. My friend told me that." So it's a fun way to start a conversation when you have to debunk some of those myths that people might have heard. As I could tell you that some people do exaggerate when they tell you stories. So be aware and look for facts as much as you can. So I love having this conversation with people, like I said, because I can bring those facts to the table and help them make a proper decision on incorporating or not. So the first part of our conversation is going to be about what is a corporation. It's basically a different way to organize your commercial activity or your business. So I'll kind of outline a few different structures you could be looking at when you're starting a business or you already have a business. The easiest, simplest way to start a business is as a sole proprietor. So that's basically just you. You have a business, and it could be anything. I'm going to use accounting as a business because I know and operate a business as such. So I'll use that as an example here. But if I wanted to start my accounting practice, I could operate as a sole proprietor. What that means is my income and expenses are going to be reported simply on my personal tax return. So it's just you, and it's fully taxed. So if any income that I make in that business, whether I use it for my own personal use or not, it's going to be taxed in my hands personally on my tax return. In Manitoba, I'm going to talk a little bit about our tax rates on this different type of income because it'll be relevant. So on personal income tax in Manitoba, our tax rates go from 25.8% to 50.4% once you're above that $215,000 of income. So keep that in mind. Any of that income is going to be taxed around that rate, depending on what other kind of income you have. So as a sole proprietor, again, all your income is being taxed at that level. Next up would be a partnership. It's very similar in terms of how it's going to be taxed when there's individuals as partners. So this would be more if you had several business partners involved. So you could have 2, you could have 10 people as partners in a business. And if it's not incorporated, then it's all going to be taxed, again, on your personal tax return. In this case, instead of just you, it's going to be split across in a different way. Now, finally, we're talking about a corporation. Now, this is where we're going to spend most of our time today. So what's a corporation in terms of a business structure? Think of it like it's a whole other person. It's a whole other entity for tax purposes. So, you and I both have a SIN number. That's how we file our taxes and how we kind of keep track of our income for any given year and file with CRA. We have a SIN number and we report our income. A corporation is going to have its own similar number. It's a business number. It's still a 9-digit number. And it's going to basically file its taxes just like you or I would. It's just a different type of return. It's a corporate tax return. So you structure your business in a way that is a corporation. That means that it's a whole other, like I said, I think of it as another person in the room that's going to report its own income and expenses for the year. And then how that starts to play with, your personal situation is you're going to be paying yourself from that corporation in some way, shape, or form if you're drawing, an income from that corporation. So there's 2 levels of tax at that point. So a corporation is going to pay tax initially on its profits. Then you as an individual are going to pay tax on what you receive as income, whether that's as a salary or as a dividend coming from your corporation. So that pretty well covers, the building blocks of what we're going to be talking about. So we can jump right into what are our advantages of incorporating and maybe some disadvantages of incorporating as well. So we'll start off with the pros. You have what's considered, it's called limited liability protection when we're looking at a corporation. What that means is essentially as a business being run in any situation, you could face, someone could sue you, or, you could have a situation where, you're being litigated for whatever reason. And if you're operating as a sole proprietor, that's a little scary because if you're being sued as a business and you're not incorporated, your personal liability is a risk. So your personal assets are at risk. If someone were to sue you for damages in some way, shape, or form, they could go after your personal assets. There is no real protection there for you. With a corporation, it does offer you some liability protection in that way. Now, this doesn't mean you're completely safe. You can't just go and do some funny things in a corporation and think you're completely scot-free. But at the end of the day, it does offer a level of liability protection if things do go south with the business. So it does, again, give you a little bit more peace of mind that your house and your personal investments that you might have built up over years are not at risk. The next advantage we're going to talk about is probably the main one. Again, this is something that a lot of people will hear and think that if I incorporate, I'm going to save in taxes. And so I'm going to use a word today that is a little bit different. It's not necessarily a tax savings. I look at it more of a tax deferral. And what that means is when we look at a corporation, like I said before, there's two levels of tax. So again, I'm using an example of a corporation in Manitoba because that's where we are. And but the concept is the same across Canada in different provinces. But in Manitoba, a small business corporation, you run your activities through that. And let's say you earn a profit under 500,000, really, you're being taxed at 9% on the profits of that corporation. We're assuming, again, that this is an active business, so not investments or rental income. We'll talk a little bit more about that later. But essentially, I can earn up to $500,000 of profit in a corporation in Manitoba, and my corporation is going to pay 9% tax. So going back, comparing to as a sole proprietor, if I earn that much money, I'm going to be paying over 50% tax not right off the bat, but once I'm above that $200,000 mark, the difference in tax is huge. So the reason I say that's not necessarily a tax savings, locked in tax savings, is because you still want to take money out to live on. You still need to pay yourself, to pay the bills, pay the car payment, pay the mortgage, and all that kind of stuff. So money still has to reach your personal bank account at some point. What that means is you need to draw either a salary, so you can be an employee of your own corporation, or you can draw a dividend from your corporation. That's a topic of discussion we could have another day on the difference between those two types. But just think of it this way. You're taking money out of your corporation and you're paying tax once again. So now we have two levels of tax. So that means we can pay a lot less right off the bat. We're paying 9% in that corporation. But when we take the money out of a corp to take and use personally, again, we're being taxed at our personal rates, somewhere between 25 and 50%, depending what our level of income overall is like. So a corporation, as you can see, can offer this really cool tool to, plan your income accordingly. If you earn $150,000 in your business, but you really only need $50,000 to, pay all the bills, then this offers a huge opportunity to save and defer taxes till you actually need to take it out. The reason behind this is what's called the small business deduction in a corporation. The reason for it is it's incentive to build your business. So Canada obviously is trying to incentivize people to reinvest within the business. So if you only pay 9% tax on all your profits, it leaves you with a lot bigger pool at the end of the day to buy more equipment, hire more people, invest within your business. So again, we'll look at, reasons you may want to move forward or not with the corporation later, and we'll touch a little bit more on that. But essentially, again, think of it as a tax deferral. So you're going to save tax up front, maybe pay some later on down the road instead. The next advantage I want to talk about is what's called the lifetime capital gains exemption. You may have heard about this. Again, this is something that has a lot of mythology around it, where people hear it and don't know too much about it. Lifetime capital gains exemption is basically something that allows you to realize a gain in a certain way and basically not pay any tax on it. And it's very applicable to, or specifically applicable to, a couple of things. You can only achieve this lifetime capital gains exemption on small business corporation shares and farm or fishing property. So when we talk about a business, someday you might decide to sell your business once you're, retiring or whatnot. And if you're going to sell your business, you're going to realize potentially a gain on that sale. So as a sole proprietor, that gain is going to be completely taxed as a capital gain. With a corporation, now that opens the door to potentially having this lifetime capital gains exemption apply. So currently the exemption is up to $866,000. So you could have, start your corporation, which when you start it is your cost of that business, let's say, was nothing because you just started out of your basement. And someday you sell the business for $500,000 to someone who wants to carry it on. As a corporation, if I'm selling those shares, I may be able to access that lifetime capital gains exemption. So for all intents and purposes today, you essentially would have a tax-free gain on that sale. So with a corporation, you have that available. As an individual partnership or a sole proprietor, they don't have that access to that lifetime capital gains exemption. So that's a really big draw for a business that may be able to sell the business later. The next advantage of incorporating a business is something called continuance. So essentially, think of it this way: if a person passes away, once their business will die with them if it's a sole proprietor. Whereas a corporation is, again, that individual owns the shares of a corporation, and those shares will pass to the next generation based on their will and their wishes. So, everything that corporation owns can continue and be passed along to another generation a lot easier when it's an incorporated business. Lastly, the advantages of a corporation, we'll talk about flexibility in compensating yourself. So again, that's, up to your discretion and maybe your discussion with your accountant as to how you'd like to compensate yourself, whether that be as, an employee of your corporation where you're just receiving a T4, or if it makes sense to pay yourself a dividend instead. It used to be that there was a bigger difference between these, methods of compensation. Nowadays, it's very similar at the end of the day, but there are some big differences still in terms of what type of taxes you're paying into, such as CPP. So that's, again, we could have a conversation about that on another day. But again, having a corporation allows you to decide, how do I want to compensate myself? As a sole proprietor, again, like we said, you could earn $500,000 of income profit in that business as a sole proprietor. You're paying tax on the full amount at the personal level. So again, flexibility in compensating yourself is something nice with a corporation. You can kind of plan ahead a lot more. Next, we're going to talk about disadvantages. Before I move on to that, I wanted to mention, I forgot to mention, if you have any questions, this is a live show, obviously, so feel free to leave a question in the comments below, in the chat below. At the very end of our presentation today, Angelica is going to be, she's listening in, and she's going to throw some questions at me if we do have any along the way. So feel free, just leave a comment in the chat below. If we don't get to it today, feel free to email us. We'll leave some information for you to be able to contact us with some questions later. So moving along, we'll look at some disadvantages of incorporating at this point. So it's not all just fun and games at this point. There's also things to consider when you're incorporating a business that are not so great. So, yes, there's some benefits, but now we're looking at what are the costs associated with this corporation. So setup costs is number one. There's a few things here that I want to mention. You can currently go and set up a corporation online, and you can do it yourself. It costs, I think, about $350. I would strongly advise against doing it yourself. I've incorporated a couple of corporations of my own, and I've never done that myself. I would never, try to attempt that. I go and you as a lawyer. Lawyers are going to provide you with a much more complete set of articles of incorporation. It's documents that you need to have and things that should be set up properly. When you do it on the online version, it's a lot of stuff ends up being missed. So a lot of people who do that and come to see me later, I'm advising them to go and talk to a lawyer to amend those articles of incorporation. So in any case, go see a lawyer to set up a corporation, do it properly, and you're expecting to pay about $1,500 just at the outset to set up a corporation properly. So that's, sole proprietorship is much, much cheaper. You can start a business. If you want to register a name, it's going to cost a few dollars, but nowhere near $1,500. So sole proprietor, way easier, way cheaper. Corporation is again going to cost you right off the bat. So you better make sure that it's worthwhile. Something else to consider if you're incorporating is if there are other shareholders involved. You want to consider something called a unanimous shareholders agreement, or USA. This again is going to cost extra money. What it is essentially, if you're in business with some other people, other partners, maybe you're going to go into business and you're all friends and you agree on everything at that point in time. But let's not kid ourselves. At some point in time, you may disagree about where the business is going or what you want to do with your share of that corporation. So what this shareholders agreement does is essentially it outlines a lot of different scenarios down the road that could happen, and you agree on exactly how it's going to go. So basically you identify potential problems in the future, and you agree at the time when you're still friends that this is how we're going to deal with these potentially difficult situations. So again, we recommend if you're in business with some other people with different shareholders in a corporation, you want to consider setting up a proper USA. And again, that's going to cost, depending how complex it becomes, it could be a couple $1,000s again with a lawyer that does it properly for you. Additionally, when we're talking about setting up a business as a corporation, there's going to be some additional administrative burden. What I mean by that is, again, we're talking about having this corporation as a separate entity. So as individuals, we all have to file our personal tax returns, and a corporation is going to have to file its own tax return. So instead of just filing your own, now you have a corporation to worry about. It's a whole other filing that has to be done. There's potentially GST is something that you could have as a sole proprietor or a corporation. But again, these things all add up. You're going to have additional things to file with a corporation. In addition to that, the level of bookkeeping you have to have when you incorporate a business is much more rigorous. You have to be able to produce a lot better reporting as a corporation than you would as just a sole proprietor. To give you an example of what you're reporting at the end of the year, as an individual, as a sole proprietor, really you're looking at, this is a simplified way to look at it, but you're really just providing on your personal tax return, here's the income I earned, here are the expenses, and I'm going to pay tax on the difference. Okay, so pretty simple. That's something we can all kind of come up with. We can show an income statement pretty easily. So with a corporation, it's a little different. We do have to report the income and expenses, so that's the same. But also what we're reporting is what's called the balance sheet. And for those of you who are not familiar with financial statements, a balance sheet is essentially, it's a snapshot of your company at any given point in time, and basically shows what the company owns in terms of assets and what it owes in terms of liabilities. So if you have money in the bank, you have to report that on your corporate tax return. If you have any loans, or you owe some suppliers some money at the end of the year, that all needs to be tracked and reported on your corporate tax return. So you can see how that becomes a lot more complex. Like I said, it's not as easy as a sole proprietorship. So bookkeeping becomes an extremely important function of your business, especially when you're incorporated. So you'll have separate bank accounts, separate credit cards, and again, the bookkeeping of those transactions is very important. It's going to cost you either time or money to be able to do your bookkeeping properly. And if you don't spend the money or know kind of what you're doing to do the bookkeeping, you're probably going to spend extra money when it comes to filing that corporate tax return, because the accountant that is providing that service needs the bookkeeping to be at a certain level and to be reconciled properly to be able to file it correctly. And so again, if they do that at the year end, you're going to be spending a lot more money to fix what you've done if you hadn't set up your bookkeeping properly to begin with. So again, things to consider if you're looking at incorporating. It's a lot of extra work from the bookkeeping standpoint. So another disadvantage of incorporating your business is that losses are a little bit more restricted. So to illustrate my point here is maybe I start a business and I'm still an employee, let's say, of a business, and I'm earning $50,000 of salary a year. And I started a business on the side where I'm maybe earning, well, at the beginning, a lot of businesses are in a loss position. So that's what we're kind of looking at right now is if we have a loss in the business, if I'm running as a sole proprietor, it's kind of cool because let's say I have a $5,000 loss in my first year of business, spending money on advertising, buying equipment, getting all set up. Now that $5,000 loss will reduce my personal other income. So my $50,000 T4 that I get from my job, I'm reducing my income overall for the year, taxable income, by $5,000. Now I'm only paying tax on my $45,000 net. So that's kind of nice when you're a sole proprietor. You can use those losses pretty easily and right away. Whereas with a corporation, it's a little bit different. Like if you have that $5,000 loss, same business, just structured it a little bit differently, those losses are a little bit locked up in that corporation. So with losses in a corporation, you can use them, but not against your personal income tax filing. So you'd have, in that case, a $5,000 loss. You basically have two options at this point. You either, if you had income in previous years in that corporation, you can carry it back up to 3 years. If you are just starting out, obviously, and that's your first year of business, then you can carry forward that loss up to 20 years. So once you do turn a profit and show a profit in the corporation where you would be paying tax, you can then use that $5,000 from year one to reduce your tax in year 2, 3, or 4. Up to 20 years forward before it expires. So again, something to consider if you're going to, start a business and you expect that there's going to be some losses initially, then sole proprietor might be a better way to go until things start to turn that corner. The last disadvantage I want to talk about is passive income. And what I mean by passive income is things like rental, interest income, dividends from shares you might own. These are called passive income. So it's not something you're actively, participating in a business to provide. You're just earning a passive income on that, property. So passive income is taxed quite inefficiently in a corporation. Again, I think this is a topic we could have a whole a session on someday. But if you're going to have passive income, especially real estate, that's something that a lot of people, look at. Should I incorporate my real estate holdings? And it makes it really hard to justify that when the tax rates on passive income are just higher, and it becomes inefficient even when you try to take that money out. Overall, you're going to be paying more tax in most cases. So be very careful if you anticipate having some passive income. Definitely have a conversation with your accountant about whether or not it makes sense to do so. So that pretty well covers our advantages, disadvantages. Now, to kind of recap again, now it comes to decision time. Which reasons would you have to, proceed or maybe not proceed with incorporating your business? So if these are reasons that you may want to continue forward with the corporation. If you're worried about liability. So as we talked about at the outset, there's a little bit of liability protection that's provided by having a incorporated business. So I've seen some individuals who are really, risk averse. They look to, protect their assets as much as possible. I've seen people with, you could have 20 corporations if you really wanted to. You could have different businesses, different assets held different places. If you really, want to keep all of your assets separate and different, baskets, so to speak, you can do that. So it definitely helps, protecting all those assets from each other and their activities. Obviously, the thing with that is keep in mind the costs associated with maintaining and setting up all those corporations. So, again, like I say, if you're worried about liability, potentially some validity to incorporating your business. Another reason you might want to move forward with incorporating your business is if you anticipate selling it later. If it's a business that you think you could build up and you're building a brand, and someday later when you're done with that business, maybe it's attractive for someone else to pick up and continue your business. If it's something that you're able to sell later, it might be a good idea to incorporate. Again, accessing that lifetime capital gains exemption is kind of a special thing that doesn't come up very often, and if you can access it, it's great. And lastly, if you want to proceed with incorporating, is if you have the ability to defer tax and do some personal tax planning. If you don't need all the profits coming from your business, and you want to again reinvest more within the business. So if you're earning 100K and you only need 50, that 50K is only the excess is only taxed at that 9%, and it leaves you with a lot more to continue the business and grow the business. So if that's an opportunity that you see with yourself, then it may be worth incorporating. Now, reasons that you may not want to proceed. If you don't anticipate, having the earnings, and this is a hard question to answer, because some people say, well, how much do I need to earn before it makes sense to incorporate? And it really, an answer that we typically give with a lot of the questions is, it depends. So it depends, how much money you need to live on. It depends what your other sources of income might be. But at the end of the day, like I said, if you're having, you anticipate limited growth and earnings in the corporation early on, it's really not going to provide you with any benefit. Probably don't want to proceed with incorporating your business if it's simply a very simple real estate rental business. So if I had a rental property where it's maybe one or a couple doors, I probably wouldn't bother incorporating. It doesn't really give me any benefit, because again, that it's taxed inefficiently, and it's not giving me really any additional, potentially some liability protection. That's the only real kicker there. But at the end of the day, like, you got to weigh your risks, and you're paying insurance on the property, and like I said, you probably won't see a real benefit out of incorporating a real estate rental business. Again, it depends. So again, it's a conversation that you should have if you're considering it. And lastly, again, it kind of ties to the first point, but you probably don't want to proceed if you have some losses that you're anticipating in the first couple of years. There's a lot of investment in the first couple of years of operation. It makes a lot more sense to keep that as a sole proprietorship. Again, it allows you to use those losses immediately. You can use it against other income that you still have. So, make use of it while you can, and you can always incorporate your business as things, like I said, turn the corner. There's ways to get your assets and your business into a corporate structure. You don't have to, it's not an impossible task. It's something that we definitely help our clients with all the time, is, transitioning from a sole proprietorship that starts to make enough money to make sense to incorporate, and we move that business into a corporation. So it is possible. So that pretty well covers the topic of the day. So I'm going to open it up to some questions if Angelica wants to jump in and ask me some questions.
Hi, Kevin.
Hello.
Looks like we have a couple of questions here for you.
Right on.
The first one, what is the difference between incorporating a federal corporation and a provincial corporation?
Okay, that's a good question. So you can, when you're setting up a corporation, do it, well, I'll use Manitoba as an example again. You can either set up a Manitoba corporation or a federal corporation, which is a Canada corporation, essentially. The biggest difference here is going to be with regards to your name protection. So you can operate in more jurisdictions as a Canada corporation and not worry too much about your name conflicting with someone else in another province. Some people may think it gives you more prestige, like on the international stage, for having a Canada corporation. The only thing I'd say, like, most corporations that we deal with in Manitoba are Manitoba corporations. If you're going to be operating primarily in Manitoba, then I would recommend just sticking with that. If you are potentially like an online business or something where you're going to be touching a lot of different jurisdictions provincially, it might make sense to do a Canada corporation. But keep in mind that it does it will probably be more complicated and a little bit more costly to have a Canada Corp, because even though it's a Canadian corporation, you still have to do certain registrations in different provinces if you're going to be, operating in different provinces. So most cases, I recommend just keeping it provincial if it's going to be, located and primarily operating in one province.
Thank you, Kevin, for answering that. The next question that we have is, can a spouse or a child be a shareholder of my corporation?
Yeah, so that's a really good question. Very relevant these days, because it used to be a huge advantage. If I was doing this presentation 3 years ago, that would have been probably number one on my list of advantages to incorporating is what we used to call, income sprinkling or income splitting. With some tax rules that changed in 2018, basically they input these new rules to basically avoid tax planning using small corporations. So the biggest hurdle to us doing this anymore is what's called tax on split income. It's TOSI. And these new TOSI rules, I'll give you an example of like what we used to do about 3 or 4 years ago, is if you were drawing out $100,000 from the company and you had spouse A and spouse B, spouse A was actively working in the business, spouse B was staying at home with the kids, we could split that $100,000 that they're withdrawing from their corporation, $50,000 each. What that does is it keeps your income in lower brackets rather than having someone in a $100,000 income bracket. Now they're both in the $50,000 bracket. So it really helps in saving taxes. So it could be a spouse, it could have been a child who was above the age of 18. So we could do that before, and now it's a really difficult thing to accomplish. Now you have to really be aware if you do make a shareholder out of your spouse or child, if you're going to be paying them anything, it has to be either there's rules in place to make sure you're not just paying them if they're not actively involved in your business. So there are some other opportunities for them to receive income. If they're over 65, this doesn't apply. But generally speaking, you don't necessarily want to include everyone as a shareholder these days because, again, the benefits have been reduced greatly. Again, be very, very careful if you're being, aggressive in splitting income. If that individual is not actively involved in the business, then essentially what they're doing is they're taxing at the highest rate. So yes, you can make, other individuals of your family shareholders, ideally if they are active in the business. So hope that answers your question.
Yes, that does answer the question. Thank you for the update on the 2018 rules.
For sure.
That looks like all the questions that we have at this time. Thank you.
Right on. Well, thanks everybody for tuning in today. And like I said, if you do think of any other questions later on down the road, feel free to shoot us an email or contact our office anytime. We're happy to have these conversations anytime. So hope you enjoyed your beer, your coffee, and have a great day, everybody.